Okay, hi, welcome everybody. Welcome to this COVID-19 focus session. Hopefully we'll get some insight from the three guys around the table this afternoon to focus on what happened in the COVID-19 crisis. Sid, if I could come to you first and ask you, just explain the background to where you came at this from and exactly what happened and how you organized yourself back in March 2020.
Sure, David. From a fixed income perspective, what had been happening in the fixed income markets kind of leading into this crisis was the markets were going through a lot of evolution and modernization, kind of heading more towards, from a PM and trading point, almost equity-like in terms of using more and more electronic trading, more algorithmic trading, being able to use large baskets of securities, either in the form of portfolio trades or ETFs, to effectively transfer risk. So from a PM and trading perspective, what we were really doing to kind of stay ahead of this curve was really ramping up all our teams and resources in the side of technology, because we recognize that that's kind of where the industry was heading. Then we get hit with March, with COVID, and then the market starts selling off. And from a liquidity standpoint, it gets pretty ugly for fixed income. So all the flow that we're seeing is just one way, it's all sells. And very soon in March, we start seeing the liquidity in the electronic platforms drop very, very quickly. And to the point that at some point in March, mid-March, let's say, it almost felt like they were turned off for us. So what we had to do at that point really was almost revert back to the old school style of PM and trading fixed income, more hand-to-hand combat, as we like to call it, where it's a PM literally picking the kind of bonds from the portfolio where we think we'll get liquidity. The trader is picking up the phones, calling up counterparties to source those kind of bonds. And then once we actually get the trade done and meet the kind of the redemption requirements, almost going back line by line on the portfolio to make sure that the funds that are kind of left behind are still in the right shape that we want them to be. So it's an exceptionally challenging period for us. And then since March, it's been a different world again for us. So, come April, Fed comes in, there's central banks helping out, there's, fiscal policy happening, and then the markets have kind of rebounded. And from a PM and trading perspective and this kinds of flows that we're seeing, electronic trading now is pretty much back to where we were, kind of pre-crisis levels. So we've now almost switched back to the original path that we were on in terms of, again, ramping up for technology, getting all technologists on board, et cetera. So, in terms of what we've learned from this really is that, the technological revolution we believe is here to stay. So that's a given. So we need to continue to develop the PM and trading teams to go along this path. But we also recognize that when we get hit with these kind of black swan events, that really having the kind of market expertise and sector expertise and knowledge of kind of who to go to is really, really critical and helpful. So maybe one of the things is we start having more of our trading counterparts on speed dial more often. That's one of the things that I take away at least.
Right. Okay. Well, Sid, thank you very much for that. So it sounded like hand-to-hand combat. There was some strong views there. I'm interested to see. And you're coming at this, just to re-emphasize, from the portfolio management side, and from a London base, if you don't mind me saying. So you're coming at it from that perspective. So I'm going to switch now to Milan and talk to Michelangelo in Milan. Now, Michelangelo, you do actually have purview from a trading perspective across multiple asset classes. I already kind of know that. Equities, FX, fixed income, etc. But, take us back to your immediate reaction in March. What happened for Eurizon in March for you? And do you agree with it, with Sid? It was hand-to-hand combat, apparently.
Absolutely. I think we all in the fixed income space had the same experience. And it was really a tough exercise to find levels, tradable levels in more on the selling side, but anyway, on the buying side as well. With this premise, actually, the fixed income as asset class was very really beyond, let's say, other asset classes such as equity and FX, because we had across all the asset class wider bid-offer spread. The tradable quantity was very small compared to the past because dealers tended to not take risk. But the price we saw on the screen for equities and FX were reliable. This was not the case for the fixed income and bonds, and the lower the liquidity of the bond and the rating, the lower was the visibility we had in terms of trading levels. And we saw this in the fixed income space, but a mirror of this view we had was in the ETF space, because we know that ETF tended to trade at different levels from the NAV. This is an important starting point, I think, to think about the fixed income. I think that Sid was, I tend to agree with Sid in the sense that we have to evolve in the electronification in trading terms, I mean, on the fixed income, but at the same time there is a limit that we saw in March this year, but it's something that happened other times in the past. Anytime there is a huge repricing in the fixed income space, we have difficulties in trading illiquid bonds, or let's say something that tend to be charged massively in the dealer's balance sheet. So anyway, what we learned from this crisis is that buy side and sell side have to cooperate in order to find let's say a better level of cooperation, and it's something that will stay with us, I think, for the next years to come. So there will be a limit in the electronification trend that we saw over the last years.
Okay, Michelangelo, thanks very much. Just to make sure I've understood you correctly, I'm hearing you kind of say that fixed income, even despite the differences between fixed income and equities and FX, had a relatively poorer crisis, meaning it deteriorated more than you expected, and equities and other asset classes held up a little bit. I know there's structural differences. Is that what you were saying earlier?
Absolutely, absolutely. Yes, even with mid-cap, small-cap equities, it was not an easy exercise to sell these equities, but it was something that we could do. This was not the case for the fixed income. Price in the fixed income space were not reliable at all. And unfortunately, this trend went on for many weeks after March on one side, on another side. Because we, for instance, in the ETF space, we saw a bid skew. I mean, prices were not reliable on the bid side just because for some reasons, at the end, if you wanted to trade ETF, we saw that ETF dealers were keen to pay you more than NAV you could see on the screen.
Okay. Okay, excellent. Well, listen, we're going to switch back to London. In fact, not just London, we're going to speak back to Royal London, in fact, back with Kevin here now. So, Kevin, you're hearing, on one hand, it's hand-to-hand combat back in March. You're hearing that fixed income had a relatively poor experience of this. But what did Royal London do back in March to immediately respond to the COVID crisis?
Well, I think, I mean, Sid kind of hits the nail on the head. Yeah, I mean, hand-to-hand, yes, maybe. It was certainly going back to the old school, that's for sure. And I think that just re-emphasizes how fixed income is a relationship business. You need to know who you're trading with. The traders on the other side, the sell side, need to know who you are. They need to have met you. They need to trust you. They need to understand exactly what you're looking to do. So I really would re-emphasize that point. And in terms of how fixed income performed, yes, our price is reliable on the screens. I think we all know that in fixed income, through times of volatility, you're not going to get the same level of transparency that you're probably going to get in equities. But I think fixed income did perform pretty well. I mean, if you look across some of the more illiquid asset classes, if you look at US high yield, for example. We trade a lot of US high yield at Royal London. I think that market actually did what it was supposed to do during March. We saw bid offers blow out, yeah. But in terms of actual trading volumes, I mean, if you look at the trading volumes from Trace in March, those volumes trebled in comparison to what they were at the beginning of the year. And if you look across, historic trading patterns, if you look back to 2008, 2012, you really saw kind of trading volumes drop off during those periods. But March this year, during the crisis, we actually saw trading volumes pick up. So I think, I think the market did what it was supposed to do. It was bumpy. It was a bit of a roller coaster. It was an interesting place to be. But I think the market performed relatively well and did what it was supposed to do.
Okay, Kevin, can I ask you just a supplementary there, if you don't mind? But clearly, nobody wants to benefit from a pandemic and COVID and a tragic situation that COVID is. But it sounded to me there that if you knew how to navigate the hand-to-hand combat, there were actually opportunities there for you to pick up on in terms of the volumes of trading. Was that right, or did I sort of miss that point? I felt like you were very confident about that part of the market and maybe even opportunities that you were able to convert.
I don't think it was necessarily, not many people were in a position where they could convert opportunities in March. As Sid mentioned, the flows were one way. There was a lot of selling going on, right? But the market performed relatively well. We were able to transact. We had to work very closely with our portfolio managers. We had to work very closely with the sell side to execute some of that business. But it wasn't a case of, people weren't picking the phone up to you. So I think the market performed better. If you'd asked me in December, how would, something like the US high yield market react to a crisis like COVID? I think we saw much better liquidity than I anticipated.
Okay.
Yeah, just to jump in there. Sorry, I mean, I completely agree with that view that Kevin has, right? And because it wasn't broken, right? It was difficult. It was difficult to get things done, but the point is we were still getting stuff done, right? So that's the key point. And in terms of even things like the comment on that Michelangelo made on the ETF NAVs, I mean, we'd argue that is the true reflection of where the market was. So if you think about the fixed income indices, they've got 20,000 bonds in their index. If you look at something like the Global Ag. Now, normally, only a very small subset of these bonds actually trade. And in the crisis, that subset is even smaller, right? So the ETFs are actually reflecting via their prices the actual events that are happening and the actual levels at which these bonds are clearing. Whereas the NAV is just representative of the entire universe, right? So that's got a lot of stale prices in there still. So which is why you see the NAVs kind of the price of the ETF moving up and down over the NAV. But we'd argue that is the right price, and that is actually giving you a lot more color into what's actually going on in the market.
Okay, great. Listen, guys, we're going to talk a little bit more now of this same issue, but from a sort of more macro level, and also from a long-term level. So if you can bear these sort of two questions in mind as we go around. And Michelangelo, I'm going to come to you first. Has this whole experience of COVID, made you take a different view at a macro level of different parts of fixed income, how you would deal with things, in the future, different sectors like we were talking about, high yield, emerging market, governments, credit, IG, whatever? Has it made you and Eurizon take a different view? And I guess the second part of that is there anything that you're now going to do longer term that you didn't do last year in process terms or the way you organize? You're just going, we're going to do that from now on. This is going to be part of the way we do things. So sort of a macro question about asset classes, if you like, and then a question about what long-term changes you're going to keep from what you've done this year. Is there anything that fits that bill for you, Michelangelo?
Well, I think that as I said before, what we learned from this crisis is that all the trends we have seen over the last years have a limit in the fact that at the end you need dealers in order to implement quickly your view in the fixed income space if you are big. So the natural liquidity fixed income as asset class can give you depends on the size you usually have to implement quickly in the market. So a partnership, as I said coming before, is very important. And I think in the future, dealers may tier clients more and more. So the electronification trend will go in parallel with partnership with between buy side and sell side. This is a clear trend. And another thing very important that we learn from this crisis is that at the end we have to be ready to shift from the old school to the new school and back before. So it will be very important to stay flexible because we don't have electrification won't be a silver bullet to find liquidity in the fixed income space. That's not the case for the other asset class, to be very honest with you and my colleagues. One important fact that I want to highlight in this meeting is that at the end, prices on the screen for equities and FX currencies were reliable on the screen. This was not the case for emerging markets high yield. So the discovering price exercise were very tough in March. So I tend to repeat myself, but it's a very important starting point for all the industry and I think for the regulator.
Right, but Michelangelo, does that mean you're going to take a slightly different view of emerging markets now? Do you think that would affect your view as to whether you want to be as involved in that asset class, or you're just going to bear the pain and get involved anyway?
No, we want to be involved in in all the asset class. I'm just saying that the asset class, for instance, that didn't have support from central banks went on to suffer in April and May, for instance. And that's it. So this is something that you have to be ready to face a different situation. In the other asset class where you don't have the principal protocol, the electrification is they are leading the electrification trend, and more of these tools are really that we are using in the fixed income space. Equities, for instance, started to use algos 20 years ago, something like that, portfolio trading 20 years ago. So it's a fact that in the fixed income, we are back 10, 20 years, something like that. And the main fact for which we are back is that at the end, as Kevin said before, fixed income business is a partnership between dealer and buy side.
Okay, well, listen, we're going to interesting comments there about, sometimes it's about the partnership with dealers and the long term, but that's certainly one of the longer term messages you've taken away. Sid, coming to you, I think you're quite big as well. Maybe I'm right there in terms of the footprint that BlackRock has. Would you agree with some of that? What are you going to do differently longer term now based on your experiences of COVID?
Yeah, I think, I agree with a lot of those points that Michelangelo made. And, from a fixed income perspective, yes, there's differences in behaviors in asset classes through the crisis and after the crisis. Some had central bank support, some didn't. But that doesn't necessarily fundamentally lead us to say, well, okay, we're going to shun away from one or focus completely in the other. We still think that we need to be involved in all of these sectors and in all of these asset classes. But we need to be involved in a much, much deeper state, right? So both from a PM and a trading perspective, the sector expertise that we're developing on the teams is going to be increasing. So we're going to have very focused portfolio managers, such in an asset classes such as high yield or EM, which is exactly when price discovery becomes a challenge. You need that kind of expertise to be able to A, know what is the right price, and B, where to go to find it, right? So that is where the right PM and the right trader come together and make it happen. So really for us, one learning from here is to increase our learning and amongst the team, and the concept of a generalist PM or a generalist trader kind of goes away in this world, especially in these esoteric asset classes.
Okay. And Kevin, what sort of longer term lessons will Royal London take away from this, and maybe organize yourself differently going forward, things that you're doing differently that you're just going to say, we're going to keep doing that, irrespective of the crisis going away or coming back? What are those things for you, Kevin?
I think Sid and Michelangelo hit the nail on the head, really. It's about adaptability on a dealing desk. And also, I think this whole crisis, if it's done nothing but it's really shown how important having a strong dealing desk is. If you've got an adaptable dealing desk with a skill set that can flip between a time of relatively low volatility, you're trying to bring in things like auto execution, you're trying to bring in real efficiencies to the dealing process and the dealing capabilities, but then you have the ability to flip over and really bring some experience and expertise when the markets do get a lot more volatile, so that when the PMs come to you and say, okay, right, we want to do X, Y, Z, you've got someone sitting on a dealing desk who knows, okay, right, we know that price on the screen isn't right, but we have the relationships, we have the experience to know where we think this thing should be, and this is how we're going to approach the situation. So I think it's about having experience and adaptability on the dealing desk. Going forward, that's only something that we're going to build on, and it comes back to what we've said before: building relationships, building that skill sets on the dealing desk. That's probably my opinion on it.
Kevin, let me just ask you about that adaptability. But how are you going to do? Are you going to cross train people? Are you going to rotate people? How are you thinking of actually achieving that adaptability core skill within the trading desk function?
Yeah, I think it's about you need to hire the right people. The people you do have, you need to allow that kind of cross training to happen. You need to work very closely with portfolio managers. I think the model where you have portfolio management teams sitting down one end of the building and a dealing team down the other, I'm not a fan of that. I think you need to be close. I think you need to be interacting with your portfolio managers on every trade. They want as much feedback from you as you're getting from them. So I think it's very important that you have that line of communication open. And that's one of the problems we're having working from home, right? We are missing a little bit of that communication. We're missing the learning by osmosis, the hearing what's going on over the desk. That's certainly something we're missing by not being in the office and not being all sat together.
Okay. Sid, I'm going to come to you next, because I think we touched a little bit earlier, deployment of traders and low touch, high touch models and that kind of thing. So we park that as what the model for you was before the crisis. Are you going to tinker with that, where those low touch, high touch traders are set up, how they interact with portfolio management? Is that any changes you're going to make around that, do you think, Sid?
Yeah, I think so. I think, through the crisis, what we experienced was that, when I said the example that I gave earlier about, where we felt that electronic trading was effectively shut. So, okay, so we need people to pick up the phone and call someone. We have a bunch of low touch traders. Let's leverage that, right? So what we actually were able to do really quickly was, because of the fact that we had a few senior traders that were already in the low touch desks, had done this for several years, they were able to quickly train up the other traders to actually, okay, what does it mean to do high touch trading? And we were able to quickly port them over to help us out on the high touch side, right? So that's something we were able to do. So we need to just enforce that, I think, going forward as a formal training program, to have that fungibility between low touch and high touch trading. And that is through cross training, to closer collaboration. And I think the same thing applies to PMs as well, in terms of, when I say, we are focusing a lot on technology, but also we want to develop deeper sector expertise. We want to try and bring these closer together, again, by training.
Right. So the era of the specialist low touch buy side trader is over. Is that what I just heard? You have to be more of a generalist or be able to use the phone as well. I think that's what I heard, but I'm going to ask Michelangelo, is that what because you've got the challenge, Michelangelo, of balancing that low touch, high touch across multiple asset classes. How are you going to approach that deployment of traders between low touch and high touch and the skills they need?
Well, in time of peace, it's okay to have a high specialization between high touch and low touch. When you have a crisis such the ones we had in March, you have to be ready to jump in a different setup. So as my colleagues said before, it's important to be fungible. It's important to cooperate with fund managers, and it's important to have in place a good relationship among all the members of the trading desk with PMs and so on. It's something that you need to have in place before the crisis kick in. So it's something you cannot create in a day, in a minute, when you have this kind of crisis. It's something that you have to create before this kind of crisis happen. So, but at the end, as my colleagues said before, adaptability, flexibility, fungibility, and collaboration are the words in order to face this crisis.
Okay. Oh, excellent. Listen, guys, we've just under 10 minutes to run, and I'm sure there's going to be some questions based on some of the interesting things you guys have been saying. So we want to allow time for that. But Kevin, I'm going to ask you next, if you could, just for your buy-side peers listening to this, what practical piece of advice, we don't want to think that there's going to be a second wave or a second crisis part of COVID. We really hope that doesn't happen. But what practical piece of advice would you suggest? If you haven't already thought about doing this, guys, you really should think about doing this. What would be that point for you, Kevin?
I think the key that we've learned over the last 6 months is communication. We've learned new ways to communicate. We're using technology more. It allows the dealing desk to communicate a lot more freely. Historically, it's been very difficult to get the whole dealing desk off of the desk into a room, for example, to have those daily meetings. We're now doing that every single day. The communication, is much better. The same with the portfolio managers. I think we've really adapted to the new technology. So that's definitely something we will, second wave or not, we will definitely take that forward and use that much more in the business.
Okay, I'm buying some more Zoom shares here, Kevin, as you speak, so it's fine. Don't worry. Anyway, Sid, what is that practical piece of advice you would give? But that was a joke, by the way, for compliance if they're watching. So, Sid, if for you, what's practical thing you'd say to your buy-side peers? Please, if you haven't thought about doing this, then you should be doing this. What's that for you, Sid?
Yeah, I think we talked a little bit about this earlier. I think training for me is the key takeaway here. Really, we recognize where the future is headed from a PM perspective in terms of automation and technology, and that's always going to be the focus. But in crisis times, it's really kind of the deep market knowledge and expertise that really makes a difference. So as we bring in, we're doing this, and I know a lot of the other asset managers are doing this, bringing in more junior talent that are probably more tech savvy than having like a finance background. That is great. It helps kind of diversify the pool quite a bit. But make sure that they are getting the right sort of market exposure and training, sector level training, so that when they get hit with some kind of crisis, that they know exactly what to do and how to manage risk. And on the flip side, for those who like us who've been around for a long time, we're learning how to code. So it's training in both ways, really, from our perspective.
Oh, okay. Mr. Michelangelo, what is it? What's the practical tip that you would give for your colleagues on the buy side?
Well, I totally agree with Sid, Kevin, and I would add what we mentioned before. It's important as well to have a good relationship with dealers, because in this very tough time, you cannot survive without a good relationship with dealers. Right.
So if there's a chance to get on a plane, have dinner, or socialize with people before there's any lockdown, we need to get those relationships brimming. And hopefully a conference like this will also bring those contacts together. So I hope you all make use of the connections on the apps and find somebody new and make those connections real, hopefully. But Michelangelo, any final remarks and comments on this whole COVID story for you before we close off the panel?
Just one, finger crossed.
Fingers crossed we don't get down to anything more serious than this. Sid, any closing remarks that you'd like to leave and thoughts you'd like to leave us with?
Let's get a vaccine out there soon, so that we can all get back to doing things the way we like doing them.
Absolutely, we want to be in Barcelona having a beer rather than talking to each other. No disrespect in each other's homes. Kevin, any final thoughts from Royal London?
No, I think we've gone through a crisis that none of us could have predicted. I think if we do get a second wave, we're in a much better place to deal with that. We're much better set up from a dealing perspective. You look across most of the dealing desks out there, they now have traders with the equipment at home. We're all set up. We've got better communication. I think we're in a much better place going forward if we do get a second wave.
Okay, well, Kevin, that's a very positive note on which to leave us. Yeah, I think you're right. I think the mechanisms are much more tried, tested, and around now. It may not be as bumpy market-wise, but at least the infrastructure has been tested and is in place. So positive way to end this conference and end this panel. Sorry. Guys, I just want to thank you very much for this. Hope you stay safe and well, especially given the subject we've been talking about, and your families remain safe. So thank you very much for joining us.
Thank you.
Bye bye.